so far your experience have been making good amount of money returns in very small cap companies. Is that the way you generally start out? Do you look for only small cap companies and then?
I'm totally I would say market cap agnostic.
Okay.
But I also strongly believe in the view that basically the trees don't grow to the sky.
Right.
So anybody which has a huge base will find it extremely. You can't think of Reliance being a 100-bagger from here.
True.
Okay. So anyway, so if you are thinking in terms of multi-baggers, you have to move into the stream which is like it's you largely have to take the top 500 companies out of the equation.
Right.
So and that's the stream. But now earlier my ideas were generated out of screeners and queries.
Sure.
But now my ideas is having built a network with I know quite a few people now. So now the idea generation happens by discussion among people, and whenever there are meetings, everybody talks about something that they like at any point of time, and that could easily become the starting point for you to dig deeper.
Sure.
But then, can you take us through your research process as to?
Okay.
So once, let's say, you understand the basic idea about a company, what is the next step you follow?
Okay. So one thing was when I worked with KPMG right at the start. I used to work on financial models.
Sure.
So for the first year, I was just doing financial models. So and the insight that came to me around that is, and we did a 1-month course just on modeling. What I realized early at that point of time is that financial models don't give you any particular insights. You're basically building those models to justify whatever you already have in mind. So half the time we used to get mandate from my promoter, my partner, that okay, this is the valuation. Now build a model to justify.
Sure.
So
That's pretty honest, yeah.
Sure.
So that's frankly, my analysis does not do DCF. I don't do DCF because DCF valuation, there are 2-3 levers you can dramatically change the numbers.
Right.
But I do try to track the cash flows for the next 2-3 years, and I don't like to think beyond 3 years. It's too difficult for anybody to try to even start predicting. Too many things can change.
Right.
So and another big change that happened was that earlier, because I was running queries and screeners, I tend to buy what was statistically the cheapest.
Right.
So obviously I ended up companies with big asset plays or holding companies.
Right.
And then I realized that unlike in the US, where there are catalysts or activists who would unlock the value, there is nothing that can happen out here.
Right.
So that over a period of time has dawned on me that India does not have catalysts to unlock value.
And there have been cases you can count on your fingers.
Yeah. So even again, Professor Bakshi was involved in one, and he's sworn off being an activist ever again in his life. So it's done. So now what I look at is the logic of GAP. So growth at a reasonable valuation.
Right.
So what I've seen in India, growth is rewarded over and above any other factor.
Right.
So as long as a company is growing fast, you can be rest assured it will command good multiples. So now if you get hold of a company which hasn't gone anywhere in terms of top line or bottom line, but you see there is a transition point either because something has changed in the industry, or whether their capacity, a much bigger capacity is coming into play, whatever the reason is.
Mm-hmm.
If you catch those companies at that trigger point, and just the growth itself can help the stock re-rate itself. So that is one important angle that I've tried to build into my analysis. The other is...
Can I just add a question here? So one observation here is that, and I can pretty much define it as a pre-2007 way of looking at things and post-2007-8 ways of looking at things. Initially, there was a lot of focus paid to the only P&L side of the whole thing. So if the growth is coming, no matter how bad the balance sheet is getting to get that growth, the companies were rewarded. One case in point could be Pantaloons of the world.
Or all those so-called infra companies.
Right. And they were rewarded pretty well. Do you see, and since you track these kind of companies, do you see a change in the mindset of the players in the industry now, in the market, where the value to the balance sheet have really started coming up? So now people don't really pay growth that much unless and until it is along with a good balance sheet management.
There's one big change that has happened is that earlier what used to happen is that if say a consultant like me or an investor like me goes to an XYZ company and then tell them that okay, you guys show growth and your stock can move 10x from here.
Sure.
And once in a while the promoters would agree to that.
Sure.
And then they would show the growth and show non-existing profits which were not there but they were showing it. Because what happened was that the whole idea was that okay, show profits for the first 3 quarters and then reverse in the last quarter.
Sure.
Right.
So and if the stock price moves in the first 3 quarters, then we all benefit.
Right.
So a lot of that happened.
Yeah. Take me through your selling process. You get into a company. When do you think about liquidating your position, selling your position? Is valuation a big criteria? A lot of value investors come out and say that they are guilty of selling out
too early.
Yeah. Obviously I fall in the same boat. But one of the big lessons that which has also started giving me comfort is that I have stopped selling in a single lot. I now break up my selling into 4 to 5 lots.
You do your buying also in lots, or you buy?
I have bought historically in one lot, but I'm trying to change that process also because I've been reading a bit from Ian Castle, and then I've been talking a lot to Ayush on this angle. So Ayush clearly changed his strategy where he started averaging up, and he's got phenomenal returns over the last 3 years because of that.
Sure.
Right.
So that is something that I want to incorporate, but I except for one stock, I can't say I've done it for many. So.
Sure.
Right.
So, but selling clearly, I've over the last 3-4 years, I've developed a model. So, hypothetically, I'll sell 20% on the initial. What I tend to do is when I buy a stock, I have a price target in mind.
Sure.
Once it reaches the price target, I will sell 20% of it.
Sure.
And then every 10 to 20% rise on it, I'll sell another 20, another 20, another 20.
Sure.
So, hypothetically, if the stock even doubles from the price I've initially sold it at, I'll still end up getting 50% more than the stock price I initially sold it at.
Okay.
And sometimes during that high rising up, the stock will correct. So if it falls below my initial selling price, I may even buy it back again. So just it's not incremental buying of more shares. I'm just covering the shares I sold.
I think this probably is the best learning because nobody else can teach us about the art of selling better than a person who has rode 100 bagger and a 90 bagger.
Sure. And 2 of them.
Yeah.
Or there have been third, we don't know about.
No.
Okay.
So that's anyway. So that's you just need to be lucky to even think about a 100 bagger. But I think if you get your strategies right and if you have an investing career of say 20, 30, 40 years, you will definitely get your 10 baggers.
Right.
Sure.
So and once in a while those 10 baggers will become a 100 bagger also.
Sure. But as of now, your searching is not. So let me just summarize. You don't look for specifically small cap companies, but.
So I like to look at companies which are basically which haven't shown a sharp price appreciation in the last 1 year.
Okay.
So any company that has moved up more than 100% in the last 52 weeks, I typically wouldn't want to dig too deep on it. So one of the things that really excites me is to get in a so-called undiscovered. It could be a large cap also, but which hasn't moved. So that means the market is not interested in it.
Okay, sure. Interesting.
So many times out of the circle, many companies come through where they say that it is interesting, and clearly it's interesting. Yeah. But then the company would have moved 2x, 3x in the last 1 year.
Sure.
But historically, I've given it a pass. But But now I'm trying to get out of that price anchoring in my mind. But I think I made the most money where
I'm the first one.
Where I'm among the first few.
Right.
I should not be say the
Right.
I'm among the first few. So I don't want to get into a stock when there has been a sharp uptick.
Right.
Sure. So the only thing missing in the whole picture now is your portfolio management strategy. So first of all, how concentrated or how diversified you are?
So I've always, because I read Buffett, how strong I was, I always had a relatively concentrated portfolio. So my filter is, I don't want more than 10 stocks in my portfolio.
Okay.
Fair enough.
So and in order to get the 11th stock, I have to sell one of the existing ones. So that itself makes a very tough filter for me to even think seriously about a stock.
Okay.
Right.
And is the position, so are the positions equally distributed? Like
Yeah, I like to my opening buying position typically is 8 to 10% of my long put. See, what has happened is my arbitrage portfolio has also grown.
Sure.
So arbitrage portfolio, there the logic is very different.
Sure.
You are looking at say 2 to 10% returns, but you are focusing on velocity of returns. How many times you are able to churn that money within the year.
Sure.
Right.
So and there you can take concentrated bets. So
Sure.
if I said that minimum I want to allocate say 8% into my long portfolio,
Sure.
I will not allow any stock in my portfolio to be more than 35% of my stock. So that this is learning from Ashiana. So so if it starts crossing 30%, I'll start selling it.
Okay. And then shift it to your risk arbitrage portfolio, or
No, it's lying in cash.
It's
So
lying
so
in
so
cash,
so
okay.
so I like sitting on cash now.
Okay.
So
So how much cash you are sitting on now?
40%.
40%.
Interesting.
So are your cash levels defined by market levels in any way?
Yeah. So that's another level. So I read about this guy called David Swensen.
Yeah.
So he runs the Yale
Yale.
Endowment Fund. So he wrote this book, and Yale Endowment returns over the last 30 years have been among the
Phenomenal.
top 10 percentile, if not the top.
Yeah.
So, and one of the big things he said that I have made my money not by picking individual asset managers or companies or assets, but the way I have made my money is by doing strategic allocation across asset classes.
Sure.
So he's a strong votary of mean reversion.
Sure.
So the whole philosophy is that suppose you have two asset class, and one asset class gives you a return of say 50% in a year, and the second asset class doesn't go anywhere. So after the year ends, what you do is suppose it's 50% and now it's 50 rupees, and now the asset class that has outperformed has become 75. So now 100 has become 125.
Right.
So what you do is you sell 12.5 of the asset class that has outperformed and add it to the asset class that hasn't performed. So that you again make it 50-50.
I think Meb Faber does more or less something on the same lines. Dividing it he divides it on the geography basis.
Yeah, so I'm talking about two asset class. You can divide this asset class into 5 asset class. You can do it across. So emerging market investing is all. So those guys, and that's how those emerging market ETFs are important. They don't invest in a company in India.
Right.
They would invest in an ETF in India.
Right.
So you mentioned Swensen, but he has been very popular in saying that it's not only like 20% or 30%. He said 100% of my returns comes from only portfolio allocation, and not my returns. He has very strongly propagated that fact that stock selection per se is not less important. It's not important at all.
Yeah, so I haven't gone to the other extreme. So one is that he has a portfolio scale where he can scout the global market.
Right.
So like at this point, if I say that I'm bullish on oil, so how do I build a position on oil, which is like a 5-year call?
Right.
So I don't have the wherewithal to have those kind of exposures.
Yeah, sure. So I was having this discussion with Srini, who is the UCLA Endowment Fund CIO. Actually, he came to India very recently for a lecture. Okay. So we met him and we were having the discussion. So he said a lot of this kind of endowment investing is decided by the asset liability match, and then the allocation becomes important. So for a smaller endowment fund, it will become very difficult for them to do that kind of a diversified allocation strategy, because liability won't be.
Yeah, so it's a thought process, and I'll just try to highlight how I incorporated it. So what I've done is that I review my net worth, say it's 100, and then I've decided I want to idle, say 60% has to be equity, 25% has to be debt, 10% has to be real estate, and 5% is cash or cash equivalents.
Sure.
So these are the 4 asset classes for me.
Sure.
Right.
And then I do a review every 3 months and see ideal position is this, but on the current market prices where each of these asset classes sit, the allocation is there. And once I do that review, I know that okay, I am overweight on equity. Now I want to shift money out of equity. So, but real estate is very lumpy. To decrease or increase doesn't work that way easily.
Right.
But at least on the back of the mind, I know that I now want to make an investment on real estate, or I want to exit one part of my real estate.
Fair enough.
So I've honestly done this for the last 4 years, and it's been really helpful in the sense that it allows me to sleep better at night.
Yeah. You live a very balanced life at least. No one stock can change your fortune, so to speak.
Yeah, I think that's
In the negative side, that
So on the positives, so one is the other thing is the return expectation. One of the things having trying to do risk arbitrage is another very interesting insight that I've got, which I think has been hugely helpful to me is when I used to do risk arbitrage and would have return expectations of say at least this year तो यार 30% आना ही चाहिए.
right.
That will and I started with that only. So that what it made me do was take much more riskier decisions.
Yeah.
Say I would try to anticipate an open offer. So if a news report would come and I would say that in all probabilities an open offer आ रहा है, चलो position डालो. Now what I realized is 9 out of 10 times nothing happened.
Right.
And then when I would face a loss in that trade and then exit. So and then again there's another guy who's been very helpful in formulating this strategy for me. He said that why don't you keep your return expectations lower? Say you want to play 15 to 18%.
Right.
But now look for trades where there is a high surety of getting those returns.
Right.
And once in a while you'll get a positive accident. So having said कि मेरा threshold अब 18% है,
Right.
there's not been a single year where I've been less than 20% for the last 4 years.
Beautiful.
So this is a very interesting, because if you are looking at rationalizing your return expectations, it will allow you not to take too many risks.
That makes sense. Actually, there's a lot of cricket analogy in this as well. If you go out to set a total, and if you're going to put it in your mind that this is a very friendly batting wicket, let's give them a target of 400. You're going to set that's like too stiff a target, and you'll take a stupid risk,
And you'll
end up getting
out from the first ball, so
Yeah.
you won't even spend an over.
Yeah, you'll end up at 180 or something.
Yeah.
Yeah.
So I have the interview also.
Okay, that's all.
Yeah.
So interesting.
So that's some of the insights that have come through over time. So I'm pretty comfortable with where things are now under the skins, because I'm on cash. I'm not too worried about the volatility in the market.
If I may ask, who is the person who guided you on this strategy?
So this is a guy called Nikhil Gupta. He's in Gurgaon.
Okay.
He's on a group, if you remember.
Yeah,
so Nikhilesh.
yeah.
So he's been an out and out arbitrager who just hates taking any kind of risk.
So we'll probably take his interview also on arbitrage. And
Yeah. So
that'll be fun.
So there are 100 ways to skin a cat.
True.
So you can't say that this strategy is the best strategy by far.
Right.
So one strategy may work in a particular year, another strategy will work very differently in another year. So
And anyways, the strategy has to suit your personality too.
and it has to work to your temperament also. So you might thrive on a strategy, but I can't do it because I can't sleep at night.
Right.
So or vice versa. So temperamentally, so again, investing is more about behavioral psychology than
no doubt.
IQ.
Right.
So IQ is a very small part of the entire
what makes you uncomfortable? In terms of valuation, when you say valuation makes me uncomfortable, what is it are you talking about? Are you talking about, we all know that the markets have a tendency to overshoot in both directions.
Correct.
So are you talking that, okay, there are a lot of investors I know, like we were having Monish Pabrai that day at MDI only, and he said that I sell at intrinsic value, sometime very close to the intrinsic value calculation.
Right.
Do you believe in that part, or since you know that the market tends to overshoot beyond the intrinsic value calculations, you give it some leeway and you hold it even if you know that the intrinsic value is lower than the current price?
How much is too much?
Okay.
How much
Okay.
is
Yeah.
too
Yeah.
much
Yeah.
if I have to ask this question?
Yeah. That's a very good question. I mean, let me just think aloud about it, and the thoughts evolve with time. So I'll just mention about the present thoughts which I have.
Sure.
So first of all, coming to the intrinsic value, we need to be very clear in our own minds how do we calculate the intrinsic value, because intrinsic value calculation itself might differentiate from person to person.
Definitely.
And then as Graham said, it's a range. It is
Yeah.
a number.
It's never a number. The range can also be quite wide.
Sure.
So I'll just describe how I calculate the intrinsic value for a particular company. I mean, given that it checks all the criteria which I've set in place, it's a good company which I want to invest in. So I try to foresee in the future that what is the kind of growth this company has. I mean, based on the historical past and given the scale of opportunity which this business has and the competitive position of the company, what is the very conservative growth which this company can have? And how much can I foresee? Because the further you go away from the present time, the dim the prospects become, the lesser confident you become about the prospects. I mean, if I have to chart the growth of a company for the next 3 years, maybe I can say with 95% confidence. The moment you increase the time period to 10 years, I will say possibly with 85% confidence. The moment you cross it to 15 years, I would say with 70% confidence. So with every range of timeline, the confidence decreases in the numbers. So for me, for certain businesses, the timeline is, let's say, 8 to 10 years, that I can be reasonably sure about the projections that I put in. Let me take, for example, a company where I was invested in, Sarah Sanitary Ware. So let's talk about the sanitary business. I mean, that will help your listeners and also me to consolidate my thoughts. For example, if you look at sanitary ware, now what is the scale of opportunity for sanitary ware in India? 50% of the population is still defecating in the open. That is point one. And the population is only increasing, no matter where the dollar is, where the crude oil price is, the population is only increasing at around 1% per year. And out of the existing population, 50% does not have the washroom facility in their house, or they are not using it. Point number two, people are aspirational. So right from the very first thing, having a toilet at your own home, still in the rural areas, having a toilet at your own home and having a newspaper delivered at your house is considered a very aspirational aspect. Right? So the second tailwind is the aspirational aspect of the population. Now you can put it along with the thrust which the government is giving on people to move away from open defecation. Swachh Bharat Abhiyan, the celebrity endorsements which are coming along with it. So there is, a social noise, which I would say, to get rid of this bad habit.
Let me have some clarity here.
Yeah.
You are talking about a position which was before the Swachh Bharat announcement happened, or you bought Sarah later on? So was Swachh Bharat a part of your thesis?
No. Swachh Bharat, I mean, previously also, so this has been an ongoing, I would say, governmental thrust, not only because of Swachh Bharat. Swachh Bharat was earlier known as Nirmal Bharat Abhiyan. I mean, so basic, I would say the basic thrust is that people are moving away from open defecation, and we have a huge scale of opportunity. 56% of the people are still not, have toilets. That is point number two. And there is a lot of social noise. There is a lot of celebrity endorsement. There is aspiration. There is legal thrust also, because the governments and the judiciary also is, the laws are being put in place where you can't fight the elections at the Gram Panchayat levels, at the local levels, if you don't have a toilet at home. Then there are a lot of monetary subsidies which are coming from the government for people to encourage people to get a toilet. That is point number 2 about the tailwinds which the sector is facing. Now, if we come to the players part, there are only 3 players in the country in the organized segment. I mean, major share of the organized segment is captured by the 3 companies, which is HSIL, Hindustan Sanitary, Perriware, and Cera. There are many other companies, but these 3 companies capture, I think, 80 to 90% of the organized market. Now, the third point is that in this market, 50% of the share, 50% share is still unorganized, is captured by unorganized sector. So where you have hundreds of units which are spread out in Morbi, Gujarat, and other places. So 50% of the market is captured by the organized segment, and 50% is unorganized. As people are moving towards premiumization, as people are moving towards aspiration to fulfill their aspirational needs, they are moving to buy brands. Right? So these 3 companies are major beneficiaries. Right. HSIL, Perriware, and Cera. Now there are different segmentations which these companies have done based on the premium segment, luxury segment, or the mass segment, affordable segment. Right. A lot of things which they have done, but just to give a general perspective of how long can you think in terms of time periods, I would say, for example, Cera or a sanitary ware manufacturer, I would say that looking 10 to 15 years ahead in terms of growth is quite a confident, I would say, metric for me to look at or to assess. Sure. And also coupled by the fact that entry of any new player, whether it is domestic, is extremely difficult because of the kind of entry barriers and the brands and the scale of operations which these 3 companies have created around them. Sure. So for a 4th or a 5th or a 6th player to come and really challenge these companies is quite, I would say, a remote possibility. And for an international player, again in the mass segment, there are international players who have come up in the luxury segment. You have American Standard, Toto, Kohler has come in. Yeah. But to be in the mass segment, it's very difficult for any other company to come here or a Chinese player to export here. Right? What they have done is collaborations with these companies itself, and they buy some of their luxury requirements from China. So that gives me a lot of confidence that the sector is experiencing very good tailwinds. The companies are in a very good position. No new player can come in. The Chinese can't disrupt this market. The bargaining power of suppliers is very, very poor because you are just using clay and you are using other ceramic raw materials which are abundantly available. The bargaining power of buyers is not high because ultimately they have only 3 or 4 brands to select from. There is no pricing regulation from the government. There is no threat of a substitute. There is no technological disruption which can disrupt this company or a sanitary ware as a sector. So all in all combined, it puts me in a very comfortable position to actually, look ahead 10 to 15 years that this is how this company is going to grow. That is part 1 of the thesis. The second part of the thesis is that if I look in the hindsight, this company has grown at quite a fast pace. North of, I think, 20 to 25% per year in the last 5-7 years. But what is the growth rate at which I am comfortable putting it 10 years from now? Now, again, there are 2 parts to it, the volume part and the value part. Because of the inbuilt inflation, 4 to 5% inflation or 3 to 4% inflation that we can think going forward. So the amount of volume which this company has to do is only 5 to 6% to make for that 10% value proposition for the net sales to grow at 10%. So combining all these factors, I feel quite confident about projecting the growth at a rate of 10% or 12% for the next 10-15 years for this company going forward. Sure. And also looking at the segment where HSIL, there are further offshoots to this thinking process, but this is the basic idea of looking at a particular sector, looking at a position of a company, looking at the threat of entry of new players, the foreign players, the regulation, the bargaining power of buyers, the bargaining power of suppliers. So once I have come to this kind of insight about a company and I can put the numbers with some confidence, some high degree of confidence, then I take the valuations. So So what I'm saying here is there are two kinds of, I would say, conservative attitude which I think I built into this model. One is that I am not taking a very long period of time. I'm just taking 10 to 15 years.
10 to 15 is not long, Ankur.
Well, it depends on the perspective of an industry. So that is what I said. I mean, if you ask me for any other industry, for example, I mean, Mr. Buffett just bought this company in the oil sector, which supplies, I think, parts of machineries or which are required in the oil sector. And somebody asked him about the view of oil. So he said, we are not buying it for 5 years, we are buying it for 100 years. So, I mean, if I compare 100 to 10 to 100, that's quite lesser a time.
What's the perspective? So, I mean, I'm pretty sure that the commodities and all these kind of companies essentially will fall out of that framework anyways, because 10 years, 15 years kind of outlook is very difficult to have in these kind of commodity-driven companies.
Well, I would say that, it depends from company to company. If you are looking at pure commodity companies, yes, they wouldn't even clear the first hurdle. You look at a raw material supplier, zinc player or a steel player, that will fall out of the radar. But again, there are companies which are commodity players in a different sense, that they are being able to sell brands to people. They are commodity players. For example, even Pidilite, I mean, in Fevicol, I mean, it's a commodity, but they have this huge knack of creating brands around their commodities. So that will make a lot of difference. Asian Paints. So I wouldn't say categorically that commodity players are out, but I would say that it depends from company to company, and it will simply depend on whether I am able to take a view, long-term view, whether I am able to see that this company has pricing power, whether this company would be around, this sector would be around 10 to 15 years from now. What is the bargaining power?
Would it be fair to say, Ankur, that for all those companies where you're not able to look 10 years ahead, they fall off the radar?
Yes.
Interesting.
Okay, so I mean, let me go back to the question which came into picture. Was the valuation? How much is enough, and how much is too much?
Right.
So you said you value the company,
Yeah.
and on the basis of a certain level of confidence, you put your numbers and you come up with a valuation parameter, the valuation number, whatever you feel the value of the company is, and then you buy it.
Yeah.
What's the process ahead?
So I would say, Puneet, I mean, I would start with a conservative level. So in some cases, I would say 10% is conservative for me. 10%, for example, I told you about Sera, 10%, a 10-year or a 15-year horizon is comfortable for me. In some companies that I may not have the idea about going forward 10 years, but I would say for 5 years, I'm quite comfortable that this is the kind of growth that this company can command, right? So it may depend from company to company. The time period may also vary from company to company. It can be 10, 15, 5, 8. So once I put on these numbers, so I derive an intrinsic value of the company.
Again, I'm sorry to interrupt, but I'm just clarifying it. At each step I'm clarifying so the listeners can benefit of this.
Right.
So the process you're saying, are you implying a DCF kind of model to value companies? When you're saying I put the numbers, you take a sort of a DCF number?
It's a DCF, but it doesn't require complicated set of numbers. It's a DCF. Yeah, it's a DCF. Yes. Yes. Yes, it's a DCF.
It's a DCF.
Yes.
So do you use free cash flow in your calculations, or do you use earnings as the base and then you do some kind of adjustments to those? How do you approach the free cash flow number?
So what I consider free cash flow in my mind is basically the cash which is left with the company after it has paid, every stakeholder. A lender, the capex which is required to run the current operations of the company, and also the government, which includes taxes. So which means taxes. So I mean, for me, cash flow is finally at the end of the day when you settle the bill for everybody, what is the cash left in your till? That is the cash.
The technical definition of free cash flow to equity is.
For me, I mean, I usually take PAT for free cash flow, and then adjust it for if I believe that the depreciation which the company has provided is lower than the actual which I think. So just to put in the conservative number. And also, I mean, I try to normalize if I try to see that what is the tax rate which the company, I mean the usual adjustments. Look out for the tax rate. If the company has paid 20% taxes for the last 3 years, then you know that there is some kind of benefit which the company has got and it is not going to sustain in the long term. So to normalize it, you have to bring it to 32% tax rate.
But do you refer to the cash flows vis-a-vis the PAT to see the difference between the accrual accounting, how much of a accrual basis things are happening in the company? Because in a lot of cases there will be some expenses, which are non-cash in nature or non-operational in nature, so to speak. Do you get the cash flow perspective here, or you just take PAT and then adjust it with the depreciation?
No, I would say the valuation is the last process. So before that, I have compared the company on the cash flow in terms of how different is it from the PAT. Is it different from the PAT? If yes, then how much it is different, and then why is it different? And also the cash flow before working capital changes and after working capital changes, is there a variance? If yes, then why is this variance? I mean, so all those questions.
So let me just again, for the benefit of listeners, let me put it in a flowchart sort of a thing.
Yeah.
All these things which you're doing is the quality of earnings check, so to speak, and see whether there's too much of variance, and if the variance is there, why is there?
Yeah.
Most of the times, the variance, if it's too consistent, anyways, I think you will doubt the quality of the earnings.
If there is no well justification for that particular variance.
And once it is reasonably close number, I think PAT is a very reasonable number you can take.
Correct.
Fair enough. So you derive the value.
Yeah. So I mean, I just take the PAT, which is a free cash flow number for me. I mean, after making all the adjustments, and I then take the growth for whatever time I am comfortable with.
And then you take a terminal number post that?
Yes, I use a terminal number for 3%, which is a perpetual growth rate of 3%.
Sure.
And then I discount it at a rate of 10%.
10%?
Yes.
Okay. Too conservative for me, but yeah, can you explain the rationale behind the 10%?
One, it is a round number, so it makes the calculations in my mind very easy for me.
Sure.
If I make it 11 or 12, I'll have to go back to Excel, which I don't like. So I like to make a lot of mental calculations. And once I have this, once I make a standard benchmark, so I can compare a lot of companies on the fly without referring to their numbers.
Back of the envelope calculation becomes easy.
Back of the mind, I would say.
Just to put it on the point, but that should not be the rationale for.
No, that is just, that is one part of it. The second part is, the AAA bond yield is 7 to 8%. So if I were to invest in a very safe asset, I would put all my money in a AAA bond yield, which will get me 7 to 8%. So if I am taking the risk of investing in equities, I should be paid or rewarded for investing in equities. So a 2 or 3% premium. So that is what I look for.
So so I think the only difference is that I expect slightly more premium, but then in that case, selection becomes slightly more restrictive. But let me ask you, Ankur, since you are doing a very conservative estimate in terms of your discount rate,
Right.
I mean, if I think like a concentrated investor, which you are, would you be better off taking a more higher discount rate number so that you get far lesser companies, first of all, in your valuation range, and secondly, the one you will get will be extremely at a reasonable price, and thirdly, from the equities in itself, shouldn't the premium be above the normal debt cost which is there in the market? So let's say a corporate can generally take a loan at around 11-12%. Shouldn't you be expecting more money when you're using your discount rate? Or see, one view can be very simple, that okay, discount rate is just a number, I can take 12-13% also and it won't make a difference. But I'm just trying to get your thought process behind that. Have you never given a thought to that debt ratio vis-a-vis the equity premium?
No, I mean, the 11 or 12%, first of all, that is a pre-tax number for a corporate who's borrowing. So for him, I mean, after tax deductions, it's much lesser. So the number of 10% is higher than mathematically that number is slightly higher. Now, my sense is that I want to put a lot of emphasis on the quality of the company which I am buying. So I try to keep the standards of the company which I buy very high. So the conservatism part, so I would say 80% of my time and my mental energy is spent on looking at the business, the company and the management. The valuation is like 15 to 20% time I spent on valuation. Yeah, so the point number one is that my confidence or my comfort, I would say, comes from the quality of the entry barrier which is around that company. Right? So I do not derive a lot of comfort by taking a higher discount factor.
So you come at a value number using this. Do you also apply a margin of safety after the calculation of this value, just like a norm?
Yeah, I usually, I mean, I apply a 25% margin of safety.
Fair enough. So now again back to the question you started.
How high is too high?
Yeah. So you start with a number. Till what point are you going to hold it?
So I mean, I would say that based on a lot of iterations which I've done on the return calculations, what kind of returns you can get if the price moves up beyond the intrinsic value and up to what intrinsic value. So that number is something around 1.75 times to 2 times my estimate of my conservative intrinsic value. For example, there is a company A and I have, I have a conservative estimate of 1,000 rupees per share of that value of that company. Now, point number one is that I am already truncating the life of that company to 10 or 15 years. But I know with a very high confidence and a very high conviction level that this company is going to stay for a long period of time. It's not only for 10 years. It's going to stay for 20, 30, 40 years. Right? Even more than that. So that also gives a lot of margin of safety by the long runway that this company has ahead of it. And two, so the conservative estimates are already inbuilt into the workings. And once the market has recognized that opportunity, I am hesitant to take my profits from that opportunity because the market has now realized the potential of this company. But over a period of time, like I said, I try to keep a hurdle rate of 17%. Over a period of time, as the price keeps on moving up, the expected return from that opportunity will keep on dropping. So at certain point of time, I would say I did these workings that at what price the expected return will drop to 12%, at what price will the expected return drop to 11%, right? And secondly, it usually doesn't happen that you have invested in a company and it has crossed your intrinsic value within 6 months. So it usually happens over a long period of time. So let's say 2 or 3 years. By that time, you have got more insights about the company because you are invested in the company, you are in more about the company. So a lot of nuances about the company which you are earlier unaware of, they get clarified in your mind. And you can look farther ahead about that company. Initially, let's say you were looking at 8 years, now you can say, okay, I am more confident. Whatever I thought, this company has demonstrated it. So now this company can go from 8 years to 12 years or 14 years or 15 years. So that iteration in my mind has given me some kind of number of 1.75 times to 2 times the intrinsic value. At that point, I mean, if my value of my stock reaches 1.75 times the intrinsic value, then I look very hard at it. That is my thesis still in place? Is the company delivering as much growth? And what are the headwinds which the company can expect? What is the kind of competition? And if I think that there are the thesis is diluting, then I start to lighten up my position.
What if the thesis is not diluting? So let's say you estimated a 25% growth rate,
right,
in a company,
and
you do your reworking after it reaches 1.75 or 2 times your intrinsic value number.
Right.
You did the reworking and probably the number is, you can anticipate the same growth level, maybe even higher.
Right.
But given all that fact, let's say the intrinsic value doesn't change much.
Right.
And the value is still high. Do you not sell or do you lighten up your position slightly?
No, I start lightening up my position.
So thesis changing is not important, valuation is more important.
Yes, valuation at some point of time, it becomes a very critical factor. So at some point of time, yes, I do lighten up my position.
Let's go to the process which you have zeroed down, and
Right.
also go to
My core process is based on a book which costs only $250 or so, which is little book that beats the market.
which I'll bring back to.
Yes, that's the core process, but we have modified a lot. I have my own ratios, which is I'm a chartered accountant. I think you know. So when I looked at the ratios, which everybody uses, it's part of our job to use those ratios. I looked at a ratio like return on equity or return on net worth, as it's called in India.
Right.
And return on net worth is nothing than net profit divided by shareholder capital, including reserves. So there's a flaw in it. The flaw it is that a company may have a very high RONW, but created out of a lot of debt, which is not captured in this formula. There's a second formula, which is EBITDA or operating profit divided by return on capital employed, which is ROC, divided by capital employed, which is ROC. There's a flaw in it. Why? Because EBITDA doesn't take the interest into account. EBITDA may be very high, but interest is, bankers are taking away bulk of the money. So you're actually not creating value. So I looked at these two formula and I was surprised to see nobody is using a combination of these two, which eliminates both the flaws. So you take the net profit and you take capital employed. Because for shareholders, that is what matters. I have given you the money. You borrowed. I don't care where you got the money. You have invested so much of money you're investing in the business. What are you getting for me? You're getting the net profit, out of which the dividend will flow. So to judge the real value creating capability of a company, you need to do this ratio, which has no name, which is net profit divided by total capital, that is capital employed.
I will go further to your process, but let me just ask few questions here only.
Right.
So let's go back as to why this ratio would ever come at the very first
Right.
place, right? The ratio which you efficiently said ROCE, or maybe there's a book, Damodar's book line here, and he says that okay, let's not take EBIT, let's take EBIT into 1 minus T and remove the tax component also. And the only reason why we're doing this is because we want to see, before paying off the debt holders, what is the company making on the capital which is employed by the company.
Right.
So
My question is right there. What am I going to do with that ratio? Why would I want to do that? Why would I want to know what the company is doing before paying interest? What is of value?
So should I tell you my understanding?
Sure.
So let's say if I have to compare two companies, right? The major value of that ratio comes when I'm comparing two companies where the capital structure of the two firms are extremely different, and I just want to know the efficiency of the capital, the way the capital has been utilized to generate returns. Now, if I want to do that, I would have to take interest component out to see what the company is making before paying off any kind of capital holder, be it share capital or debt capital, and just by the operation of the company, how much the company is making on the money it has induced in the business. So at least from my understanding, that is the reason why that ratio came up, and that is why the people see that ratio. So
no, once again, what is the practical utility of knowing that? I have given a very clear practical utility of knowing how much is left for the shareholder and how much that is on the total money invested in the business.
okay.
That is what matters. If you are running a shop,
Right.
you are a shop owner.
Right.
You are running a kirana shop. End of the month, you have 30,000 rupees.
Right.
You know that you have put in 1 lakh rupees in that business.
Right.
You know that you have borrowed 1 lakh rupees from your brother-in-law.
Right.
You know you have 2 lakh rupees invested in that business and you've got 30,000 at the end of the month.
Right. So that's a utility. Fair enough. So the more I'm thinking simultaneously about it, let me put it this way, that if I have to, so you are saying that no matter what the capital structure is, at the end of the day, the shareholders get paid, right? So maybe for comparison purpose, you won't want to do all those things, but when you're investing in a particular company, it's better to look at that.
I tell you what, there are lots of ratios.
Right.
Huh?
Right.
There are, debt equity, free cash flow, 100 ratios.
Right.
If you do this one ratio,
Right.
you would have eliminated the need for anything else.
Okay.
Why? Because suppose you have a cutoff of 8%, 9%, 11%, doesn't matter what. We have a cutoff of 11%.
Right.
And we also look at companies which are into 7 and 11 category to see if they come down. But that's side
Right.
work. Main work is 11% plus. Now, 11% plus of this ratio,
Right.
there are only 400 companies in India.
Fair enough.
Okay.
When you're saying you're taking the average of how many years?
This is for 4 rolling quarters. So now, if you see these companies, there will still be companies which are doing very well with it after paying off the interest also.
Okay.
So a company like Nitin Spinners.
Right.
Nitin Spinners has a debt equity of around close to 2. Right?
Right.
So if I have a spreadsheet where I have this figure and I have a figure of debt to equity ratio also, just as an additional check whether this has come through the filter,
Right.
I think I'll have about 50 to 60 companies with a debt equity ratio of more than 0.5 in this.
Right.
So see how robust this ratio is.
Sure.
So I could go and see who's borrowed, what interest rate, etc., what business, what sector. It's all irrelevant to me.
Right.
So having done this, let me continue what I do.
Right.
I have another in the spreadsheet, another thing which is your tax rate.
Okay.
Your effective tax rate, the moment it falls below 30% or so, 28%, 27%, I start to look, because then there is something else going on over there. And it's one of the reasons, of course, I was not entirely right, but one of the reasons we never touched Kaveri Seeds was the fact that its tax ratio was 0.1 or something. But that was for a different reason, which Ayush Mittal was explaining one day. But in any case, we just automatically we rejected that for right reasons or wrong reasons that we'll know later. So if you do these 3 things, you put the strictest possible test, beat 11% net profit on your capital employed, stay below 0.5 on debt equity ratio, and pay 35% tax, 30% tax, whatever the filter you want to use. And all these are, they all fall in line. There is, once you choose the first, the others will automatically fall. They are all high taxpayers. Very few of them are not. Kaveri Seeds was one of the exceptions. I said, "Itna sab company hai, why bother?" So we didn't bother about Kaveri Seeds. I'm exceptionally lucky, I guess. So once you put these 3 filters, you have only the creamiest companies in India. Now, you have 2 choices. So we're still doing, this is frozen. I mean, we had this system in place and we selected stocks on the basis of this in 2012, 2013 and so, and the results are, we beat all the mutual funds in every year except 2013, 14, 15, and then all the 2-year, 3-year, 4-year periods in each of these. Okay. We started 2012 to 13, 12 to 14, 12 to 15. All of these years we are number 1.
And if I'm getting right, this is the parallel. If let's say I draw the parallel between Joel Greenblatt and
Joel Greenblatt does use EBITDA,
just use ROC,
and
earnings yield.
Yeah, and he uses earnings yield. We don't use it, so that's another story.
Okay.
We don't use P.
Sure.
I mean, now we have started using P a little bit because it's quicker, easier. We also are able to relate to. So when we started, we were not using P, and subsequently now with more tests, the difference between what we used to use and the P is narrowed down. Right. So we may drop that altogether and start using P as going forward. But when we started, we were using operating profit to market cap. The reason we were doing that and the reason we were not doing net profit is because it's very simple. I said this first one, which is our ROC, already captures quality companies. Okay? Now what I am interested to know is on an operating basis, what is the valuation of this company? Because I don't need to now know. I have already done 1 round of filter. Now my only focus is on the operating part of the business. Operating part of the business is not the focus earlier, because ultimately for shareholders, Return is what matters. For valuation, what matters is how many times your operating profit of this set, not all set, not the entire 1,400 companies that we have in our database. Having selected this, we wanted to know on that basis. So we used to.
Forgive me, but if I can slightly ask more on this issue.
Yeah.
Why not operating cash flow or operating profit divided by market cap plus debt or EV, so to speak? And why not? Why only market cap?
No, all these things are there in the textbooks for a purpose. I think all this thing is there to help investment bankers value businesses. Okay. For mergers and acquisitions.
Okay.
When you also tried this market cap with the thing, and we picked up a great company by this. It was amazing. It was just going at a throwaway price with these numbers. Market cap plus debt, operating profit, market cap plus debt, and number 2 in that list 2.5-3 years ago was NBCC, and it was $170. So I looked at that and I said, wow, what a stock. So that's how we selected that, but we dumped that because that has no predictive value. There is using that metric, you will not be able to figure out whether the company is attractively priced or not, for the simple reason, once again, to repeat what I said, I've already moved away from companies which are heavily indebted. So I am now working with a smaller set of companies, filtered ones where debt is low. So for me to add back debt and figure out what is a business value, which is really an acquisition value of the company, is meaningless. That's why. So we used to use only these 2 metrics. Weigh them, 0.5 each, re-rank them, and then apply my mind. So what we used to do is, we still do, we have 5 categories. Unlike mid cap, large cap and small cap, we have micro cap, small cap.
Can you simultaneously give the...
Yeah, up to 100 crore is micro cap, 100 to 500 is small cap, 500 to 2,000 crore is mid cap, 2,000 to 10,000 crore is large cap, 10,000 and above is mega cap.
Sure.
So we said that we don't want to have a complete full rank. If you have a one rank, we'll end up selecting all kinds of micro cap and small cap companies. It really makes no sense. So we had this stock letter in 2 variants. One is Lion, which is more large cap. One is Antelope, which is more mid cap. And in any case, this cap sizes we have had for 7-8 years now. Right from the beginning we had, because I never understood why I have only 3. Try and segregate that even finer, because the characteristics of each are all different. And in any case, you are asking what the issues with mutual funds. Mutual funds have Axis Bank and Wipro in their mid cap portfolios also. That's one of the things that which screws up performance according to me. So we had these 5 cap sizes, and we sorted within them. So we have a rank within the mega cap, we have a rank within the large cap, and so on and so forth. The final stage is what my own 25-30 years of experience comes into play when I look at a stock, and my sense of what I know of the promoter, and so on and so forth. So there are certain stocks, certain companies, even if they're high on the list, we will try and avoid. We may not pick them, even if they're cheap. PSUs, fascinating story. When Modi became the PM, PSUs were really cheap, and we put a lot of them in our stock letter. I also suggested some of my friends also buy them. In September 2014, we sold everything, including banks, including stocks like REC and all that, which have subsequently collapsed. So we watched for 6 months, and when I was looking at the portfolio, I actually exited at a profit of around 10% over 6-month period in that PSU portfolio. So I was really lucky escape, because all the stocks have just collapsed after we exited in September, October. Some at a loss, some at a profit, but overall the portfolio, that part of the portfolio made money. So this is one time right in the beginning I said what we don't do. We don't speculate on what is going to happen. This is where we did. and we got it on our neck.
I was going to ask that because it
We-
completely negates with what you
Totally.
said.
And all this is a learning process.
Right.
This is now refined in the last 6 months even further. I'm able to articulate that we don't speculate. Is at that time, if you had asked me, I would have told you only the formula. I would not have been able to say that what I am able to, that we don't do. This I've learned from the Prashant Jain experience and some of the other people that we track currently. So our idea was that this is not the right process and to speculate. So we did that. Exactly. So that was, these are all part of the learning process. One other learning process I've described, I have not described one of the steps that I do apart from the ROC or RROC and RP.
Let's call it money life.
Yeah.
Capital employment.
Exactly.
Right.
Exactly. I don't discuss this with qualified people because they laugh at me. But, so the third one, we realize now this is more and more work is going on.
Right.
There are certain kind of companies, if they go up, I don't care because I've reached a certain emotional stability as far as my process is concerned, that if tomorrow ACC goes up 300%, I don't care. But I do care the fact that I did not recommend Britannia 3 years ago.
Right.
That really hurts me.
Okay.
So we are doing further work on stocks that have actually gone up
Right.
and why we didn't pick them and what we missed out of them. So if there's some way I'm able to refine, I've missed out some parameter which could be another parameter, I will try and do that. The third thing which we have now plugged, one of the reasons why what we missed out and now we have plugged that is a very crucial thing which is neither there in Wesley Gray's book or nor there in this guy Joel Greenblatt's book, which is earnings momentum. And this is a very, very, very important thing.
Well, that will be there in Wesley Gray's upcoming book. We'll
Okay.
discuss with him.
Right,
It's going
right,
to be
right.
book in December.
Correct. Is there. So this would separate, this would prevent you from buying a stock which is a great stock which is just not moving because they're eating up your time and capital and so on. So there are stocks which are high on ROC, which are reasonably valued, but just will not move. And we've realized this based on our previous experience. So what was missing there? Then we looked at it and found out there are stocks within our universe, the stocks that have done best have certain amount of earnings momentum behind them. So we have found a way to capture sales momentum and as well as the profit momentum of the last 4 to 6 quarters. And we have now a metric to track that and bring that as a third factor. So we have now 3 factors equally weighted.
To look at TTM growth of sales and
Yeah.
Okay.
One is the valuation, one is the ROC, one is the earnings momentum.
Fair enough.
Now, when I look at this, I'm very confident that this approach is going to beat mutual funds persistently. This is going to be far, and the difference is going to keep increasing because our returns. You see, the only a Birla Sun Life from Opportunities Fund and an L&T Value Fund have twice come. Every year, their order will change. One guy will go up and another guy will come on. But as long as we are in number 1, number 2, it essentially means that our lead will continue to increase with the rest of the industry. If we fall back on number 7, then we are again back to square one in terms of putting out. But 3 years in a row, we are number 1. And the reason for that is that we are never going to buy a stock like SBI, hoping that the banking sector, blah 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 blah, and we are also fairly confident that with all these 3 things in place, which is earnings momentum and valuation and return on capital employed, we have covered almost all the major factors that actually create value. Create enormous value.
So could it be because, say, if you look at mutual funds, is it the size which is the biggest hampering, which is not the case in your
No, size has nothing to do with it. No, size has something to do with it.
They have a compulsion to go with size. So if a mid-cap mutual fund ends up with 5,000 crores.
No, the size is
So the size does not allow
No,
them to...
no. The reason is that it's a completely different thing that I'll say now, which we haven't discussed at all, which is timing. Now, I have a firm belief that you can time the market approximately. You don't need to buy at the top, sell at the top, and buy at the bottom. It is possible to time approximately, and timing can make huge difference to your results. Mutual funds can overcome the problem of size with timing, but they don't do that. So they should be in cash. For instance, remember one of the things I tweeted
Like say, for example, that is what I was going to come to. So for example, maybe a year back, I think you have a process on your asset allocation. Wherein you were high on cash maybe in September 2014. So maybe you could say go on to that part of the model also. Wherein
this is a very important part of the thing, because that helps us show a terrific performance on the invest tool, which is part of MSSN, where the asset allocation is there. So what we've done is we've sliced the valuation, historical valuation of Sensex or Nifty or whatever you call it. And people normally take a very broad approach, 22 to 24, 26 or whatever. Now, this sounds like a number, but it's a huge variation because it's a small 2-digit number. You don't realize 20 to 22 is like 10% jump, and 10% jump for the market is not small. So we realized that this is not the way to do 20 to 24 or 26 or P is high and this is low. We have actually done a distribution of market P at intervals of 0.5. Okay. So 20.5 to 21, 21 to 25. And we have a clear sense of what should be your percentage investment in stocks at each of these intervals, as at 0.5 intervals of P, of overall market P. And this is not something anybody else has done. Even IDFC fund is a very...
It's a broad one.
Too broad according to me. Right?
3-band parameter.
Yeah, so there has to be many more bands according.
Do you do this for other asset classes to make a complete portfolio? Or
We have a tool by which if you can just put an X amount at any time, it will tell you depending what your objective. It could be a lump sum investment, it could be a SIP or whatever. So suppose you say I want to invest 2 lakh rupees, which is a lump sum. So it will tell you how much to invest in fixed income and how much to invest in equity at this time. And within the fixed income, depending on your tax bracket, it will tell you divide between FD and tax-free bonds and so on and so forth. So what happens is that if suppose I'm saying 30% in equity and so on, and I have a program to get you, let's say 60-40 should be your ideal asset allocation. I'm starting with 70-30, and I have a program to get you to 60-40 by the end of 18 months, let's say. So we have an approximate way of calculating that as time passes, what should be your investment in this. And part of this, suppose the market collapses tomorrow, so that roughly those 20 percentage points that we are not investing in equity right now, let's say it should be 60, now it's 30, so 30. So 30 gets accumulated in FD. So that particular month you will get an alert from us saying that now shift so much of money from there to get to 60-40. So we have that algorithm in our tool. And that is there for both monthly investment as well as a lump sum investment.
So this takes care of your stock selection, which is on the basis of the refined green dot version. And then the allocation as to how much goes into equities. Let's go to that portfolio which you are constructing. Are you putting equal amount of money in all the stocks which you are putting? And how much companies you are taking in? How do you define that?
I have another point to make. The reason why we have to follow this process is because we have neither the time nor the opportunity to meet companies. And also, and then I keep saying that even if we met the companies, I don't think that much value is going to be added to our stock selection process, because according to us, companies themselves don't know what is going to happen 4 quarters down the line.
Fair enough.
So let me just complete that part why we do that.
Fair enough. So you're saying that even if you have all the bandwidths, you might still go with the same process.
Yeah, except that for the micro cap and small caps, I may want to meet. I mean, meeting management may help. For instance, I give you a name of a stock called Finiotex.
Right.
Okay, the stock is sharply up today also.
Right.
Now, I'm very curious to know about this company. There's hardly any information on this.
Right.
So, if we meet them based on my experience of, assessing companies, promoters, what they are, and so on and so forth, I may be able to take a call on them without getting influence. On the other hand, the downside is that they might say such fantastic things, and human mind is such an amazing thing. We may feel that we are in full control of our senses, but we may just...
Just for an example of information, so the last time the stock went up was Amitabh Bachchan was invested in this company.
Is it?
Okay. That was a block deal.
Okay.
I think
Oh,
so.
I didn't know that.
So maybe I'll search and get back.
Amazing.
I think that is the case.
But tell me one thing, then isn't that diluting the whole idea that the biases should not come into picture? Because then the judgment will come in.
Yes, that's why we are fairly confident that we don't need to meet people to be able to get a sense of this. And in fact, in one or two cases where I met a director of a company which we had anyway recommended, and my idea was reinforced that yes, this company is doing well. The stock has just not moved up at all. So the stock moves on a set of factors which have nothing to do with what's the company is happening at this time or whatever.
So let's go to the allocation question. So within the portfolio, how do you do this selection?
Yeah, there are two things. One is that initially, suppose you are a subscriber now, what should you be doing? And suppose you are a subscriber from 2012, and what should you? There are two different situations.
Right.
If you invest now, we say divide your money equally into all the stocks. For that also we have a tool. Because if you have a limited amount of money and these prices are all different, that's one of the reasons we had to drop Eicher Motors and MRF. Both were part of our portfolio. Even though we knew these stocks are great, we had to drop them because people started complaining that you want us an equal allocation. This sets the benchmark for an equal allocation for all the other stocks. We don't have that kind of money. So we had to drop. So we also have limitations which fund managers don't have. See, it works both ways. It's all really funny. So we have a tool for that. Suppose you have 20,000 rupees.
Right.
You put that amount 20,000. You press the submit button. What the tool does is according to the smallest price stock to the highest price stock, it will give you an order. Suppose AVT Naturals is one of the stock, and its price is 30 rupees. And suppose with the last stock that you can buy out of this 20,000 allocation, suppose it was 2,000 rupees, so you can buy 10 stocks, right? So the tool will suggest you're buying 20,000, 10 stocks, 20,000, 1,000 rupees per stock. So the AVT will say buy 35 stocks. So you'll change the number of stocks that you need to buy so as to give to you an equal exposure based on the price that's your initial investment. Once you start that process, then stocks will move in different direction. AVT will go down to 20, and maybe Alembic is going to go up another 7-fold or whatever.
But generally, how many stocks are there in one category?
Right now, there are 17 active stocks in one category.
So, but when you do the ranking, do you have a set number of stocks in mind as to number 15?
We wanted to have 33 max, which we say in the stock letter. We will not go beyond 3% exposure to a single, so that makes it 33.
Okay.
We had gone up to 30, but we have reduced now, and we may add 2-3. The market crashes, we may add 5, but we are quite comfortable between 7.
The remaining is cash?
No, now this is complete total investment. This is fully invested portfolio right now.
So let's say if there are 15, then you say the allocation will go up accordingly?
If we try not to, we may drop one, we may add another. These are fine tuning. This is a kind of fine tuning which is difficult to do. You can do only in a PMS or in a fund. We are not able to do. If we see a very good opportunity, we add to them. People who are sticklers, they come back and say, you asked us to, where will I get the rest of the money from? We try to adjust that. But I really don't know what is the answer to this, because within a process, how will I be able to accommodate everybody? We don't know. So we make sure that we don't, out of 17, we don't suddenly make it 33. Then that really processes collapse there. Then it's not there, which means you are 50% in cash. So we don't do that. We just do 2, and we probably there are always stocks to remove. Not too many, maybe 5-10% stocks. Like Colgate, we were wrong about Colgate. We were wrong about Castrol, so we got rid of Castrol. We had added one more stock from there. So Colgate, we are waiting to see what happens in this quarter. We'll probably get out of that. We'll add something else. And so there's always some stock.
And what is the frequency of revaluation? Is it quarterly because the TTM changes?
Yeah, quarterly.
Okay.
These results are reviewed quarterly. The entire database is redone quarterly. Yeah.
Okay. So this becomes.
So there is a last part to it.
Right.
So what happens when the stocks start moving in different directions?
Right.
There are a lot of theories on rebalancing. Right. And the classical theories say you should rebalance back to 60-40 or 70-30. We've tested this 5 years ago, and we found rebalancing has no merit.
Okay.
And I was very heartened to see that somebody else has come to the same. Coffee can portfolio. If you see that, I was just reading it a few days ago. They said if you do not see, what happens is the best gets better and better and better, and this reduces in terms of value, in terms of portfolio. So you really don't need to do anything over there. So their study again reinforces what we had found out 5-6 years ago.
Are these studies available for people to read?
Coffee can is available.
No, what you did with Indian stocks?
We did with mutual funds.
Mutual funds. Okay.
So once we did it with mutual funds, we said that
to test the rebalancing theory.
Doesn't work. Okay. There's no need, is what our sense is.
Okay. So let me. Okay.
So when the stock really is not performing, like a Castrol or Colgate, you get out.
It will automatically get out of you.
Yeah. So that's it. That's the exit. Yeah.
Right. So your selling decision is based on your ranking of stocks on your parameters, and if it goes out, it goes out.
Yeah.
So there is no story, theory, nothing like that. No looking forward in future.
Absolutely.
Okay.